Hello traders, welcome back to the Forex Geek channel. In today's video, we are going to be talking about professional trading strategies that set apart top tier traders. We will learn the core approach used in momentum trading, mean reversion, and trend following. This method form the backbone of professional trading system across various market conditions. Stay tuned as we break down each strategy and show you how to apply them efficiently in your trading journey. Now we'll start from the momentum trading strategy. Sorry. Let's explore momentum trading, a strategy favored by many professional traders. Momentum trading involves capitalizing on strong price movement in a particular direction. Momentum trading is also known for its key successful momentum that lies in identifying assets that are moving significantly in one direction and entering trades that align with this movement. You would need to spot these opportunities quickly and act decisively. One effective method for the momentum trading is the breakout strategy. This involves identifying key resistance or key support levels and entering a trade when the price break through these levels with increased volume. Now let's look at an example. We can look at this part of the market. We can see that price is struggling to break the upside and is struggling to break the downside of this market. Let me mark it out. This is a formal support turn resistance, while this is a support. As we can see, price is struggling to break this area. So how do we implement the breakout strategy? We can implement this strategy by identifying the strong resistance and some strong support levels. We wait for price to approach these levels. We look for a decisive break of these levels, preferably with increased volume. So we have to turn on our volume indicator. When price breaks this level with an increased volume, as we can see, price broke it and came back in. The volume was at minimum. We can notice price broke it and came back in again. The price was the volume indicator was still small. It wasn't showing an increased volume. But when price broke it for the last time at this area, you can see there was an increasing volume here. We enter the trade in the direction of the breakout. So we would have to enter this trade. That's a long position in the direction of the breakout. We put our stop loss just below the breakout level for long trades. This is below the breakout level, or just above for shorter trades. If you are taking a selling position, you put it above, but in case of this bullish trade, we set it below the level or below the swing low or whatever low you can see there. Remember, not all breakout leads to a sustained momentum. That is why it is crucial to use additional confirmation tools such as the momentum indicators. The RSI, which is the relative strength indicator, relative strength index indicator, is a popular momentum indicator. When the RSI reading is above 60, let me include my RSI to this chart. As you can see, once the RSI is above 60, this reading indicates strong buying pressure. As we can look at this area that we bought from, the RSI was showing us is above 50, is above 60 rather, which shows that there is a strong bullish momentum at this area. Then in case of a bearish trend, let's look at a bearish trend. Let's look at this area where we saw price trading to the downside. We can see that the RSI was below 40 to 30. Shows that there is a strong bearish presence or bearish momentum coming in the market. Now that's for the first strategy. The second one is the mean reversion approach. The mean reversion approach is a strategy widely used by professional traders. The mean reversion is based on the principle that price tends to fluctuate around an average or mean value over time. One effective method for the mean reversion trading is the Bollinger Bands. The Bollinger Bands consist of mid-bands especially, or usually a 20 period moving average, and at the outer band these are represented by standard deviation from their averages. So the inner one is a 20 moving average while it has the outer deviation area. The basic idea is that when price moves significantly away from the mean, they tend to eventually return. This creates trading opportunities. Now let's see how we can use the Bollinger Band for mean reversion trading. We have to first wait for price to touch or exceed one of the outer bands. As we can see from this example here, price have exceeded at one point. At this upside, price exceeded even at this downside. The downside of the Bollinger Band, price has exceeded the outer layer and is coming back in. Once price exceeds, we look for signs of price reversion or price reversal, such as candlestick pattern. Judging from this down candle that exceeded, the next candle showed us it was a bullish engulfing, which shows that we have to enter a trade in the direction of the expected reversion, since we are trying to get a bullish setup because price broke out from the lower layer of the Bollinger Band. We would enter our trade at the close of the bullish or whatever candle pattern you see there. You put your stop loss just below the recent extreme price. Then we target the midpoint of the band, which will give us 1:1, and we take our profits at that area. It is also important to note that the Bollinger Band works best in a ranging market, but in case of a strong trend, price can walk the Bollinger Band, touching and exceeding the outer bands for extended period of time. To increase your chances of success, we have to combine the Bollinger Band with other indicators. That is for a trending market. The indicator we can combine this Bollinger Band with is called the Relative Strength Index, the RSI. With the Bollinger Band combined with this strategy, all we need to do is note when price at the RSI gets to the 60 or 70% area. Once price is trading at the 70 area, it signifies that price is willing to a bearish reversal. So I'll repeat, when the RSI is above 70 is a sign of a bearish reversal. So trade is going to reverse from a bearish trade to a bullish one. Similarly, when price is at the lower band of the RSI, at this area, price is at the lower band of the RSI. Okay. Now the next trading strategy would be the trend following method. Now the trend following method is the cornerstone is a cornerstone strategy for many professional traders. The trend following is based on the principle that markets often move in a sustained direction or trend, which can be exploited for profit. One of the most effective trend following techniques is called the moving average technique. To identify and confirm trends as well as potential entries and exits, we use the moving average strategy. Now, how can we implement this strategy? We can implement a simple yet powerful moving average strategy by first adding our two moving average, the 20 and the 50 moving average. The use of these two moving average, which is the shorter term moving average, the 20 moving average, which is the shorter, shows this red line here on my chart, while the 50 moving average, the longer period moving average, which is the blue line on my chart. When the shorter moving averages cross above the long term own, it is a sign of a potential uptrend. When the when the short moving average, that's the 20 moving average, crosses above the longer term own, that's the 50 moving average, is a sign for higher prices. That's the same thing with when the shorter moving average crosses below the longer or the bigger moving average, that's the 50 moving average. When the 20 moving average crosses below the 50 moving average, is a sign of a potential downtrend. How do we enter trades? We enter trades in the direction of the crossover, and we use the long term moving average as a dynamic support or resistance level for stop loss placement. When we enter this trade, let's assume we want to enter this trade. First of all, to refine this our entry, we look for a pullback. We look for a pullback to the moving average after the crossover has occurred. We enter after the crossover has occurred at this area. We wait for a retest to any of the moving average. When we see the retest, we can take our trade. At that pullback, we put our stop loss above the moving average around that area. We can give ourselves 20 pips to give ourselves enough breathing room. Then we target our 1:2 or 1:3. This often provides a lower risk entry point in the direction of the trend. So it is crucial to remember that no trend lasts forever, but if required to trade, we have to always prepare for a potential reversal by monitoring price action and by adding of other indicators. One way we can do this is by making use of our average directional index. Our average directional index, when it has a reading above 25, it typically indicates a strong trend. So when we look at the area and we see it has a value reading above 25, it shows for an uptrend. Let's look for an uptrend. At this area in price, this is, you can see this is a clear uptrend. Price is trending to the upside. We need to look at the value of the reading on our ADX, our average directional index, and we can see that this reading is above 25, 30, 25, 29. This is the reading of the uptrend we can see there. While if we are trying to read, if we see a reading below 20, if we see a reading below 20, let's go back to our example. A reading below 20, a reading below 20 is a sign of weak trend or a ranging market. Let's look at this area where price is ranging. Price is ranging in this particular area in real time. If we check our check our ADX, we can see that price is below 20. It's fluctuating, but you can see that it's below 20 in this particular area, showing you that yes, we are in a ranging market. So professional trading strategies like momentum trading, mean reversion, and trend following are powerful tools in your trading arsenal. Remember, success comes from consistent practice, proper risk management, and adapting these strategies to your style of trading. Keep refining your approach as market evolves. If you found this video valuable, please hit the like button, subscribe, and turn on notification for more video insights and more trading insights. Thank you for tuning in, and until next time, happy trading.